What's up to everybody out there, especially those that's looking to understand or do equity financing. So today we're going to go straight into the episode that's dealing with the peer funding structure. And we're going to start this thing on over here with a trust. You know what I'm saying? So invisible waterfall trust. It shouldn't correspond with your last name and all that family stuff and good things of that nature. But let's get into it. So right here, we're going to do a fund first, right? So the fund name going to be like all the rest of wealthification examples, templates, whatever you want to consider it, right? Swift Weight Inc., which is a C Corp. Why I always tell you it's important to do a C corporation because you're getting funding. So you're looking for funding for, different investors, etc. In most cases, it got two types of shares, stocks, preferred stock and common stock. That was some investors looking for. Like I told you, to protect their capital that they're going to be investing. So that's why I say a fund or investment company, capital, markets, and securities via performing assets. What I'm talking about, right? This fund is set up to go into the market that's going to acquire performing assets, things that's already performing, from bonds, stocks, companies, derivatives, which is the same thing I just said, things that's already got an interest or dividend that is going to be paying out. So what happens up here is this is the Delaware Anonymous Structure and Holding Company, right? Within that, you got two sides, like I was explaining to you in my last episode. You got on this side, you could issue bonds, which is indebted, or you can borrow money, which will put debt on the books. But most of these start out with, more equity, where they raise equity, capital equity financing, issuing stocks. So within Delaware, you got the minimum, you could issue a minimum of 10 million shares at 0.001, or you could add a face value how much you want. They already have too many restrictions and regulation on how you issue the shares back to yourself or your partners, etc. So with that being said, this create a paper valuation, but we're not going to talk about the paper valuation yet. We're just talking about the issuing of stock. So right here it's going to be the LP. The LP could be a variety of LP. So you might have, several different limited partners which coming in as stockholders, etc. So with that being said, okay, the LP, right, is tied in to the other operational company, which you is the GP, which is the general partner or the general manager. Different, things for different purposes and different reasons. So right here is the Swiftway LLC, which is an operational company that's actually going to be, a manage. You don't want to do a member manager all the time because you want to have, you are one more partner have, full control over how many accounts are being established and open and being, used at the time. So you go probably, most time you may have a LLC that's actually, involved, that's controlled or owned through the LP, and it's gonna have a capital account that's tied into each investor that come in and put the money, which is investor capital. So you can see the measure of how much money they have that's invested and coming in, returns on investing and things of that nature, right? So like I said, it's a variety of these. I ain't gonna go LP, but like you say, people could come in as individuals, as their real name, John Doe, so they might come in through a LLC as a limited partner, might come in as a trust, they might come in as another corporation, might come in as a donor, they might come in different forms, institutions might come in. So over here, the whole catch is you attracting, and when I say attract, you going to them, but you was attract people, you have your preparation or your proper documents that's involved that make it more attractive, and you going to them not just looking to raise funding, but you going to them as building a relationship. So it's going to be in credit to investors, right? Like I always tell you, the credit investor is someone worth $1 million or more. It could be a high net worth individual, 15, 20 million dollars or more, right? You got the institution investors that's, big, banks, insurance companies, big organization that manage a lot of money and a lot of securities at a time, deal with billions of dollars, you could say, at a time. And you got the family office, like a lot of big wealthy families, you'll notice they have a family office that they take all the, surplus capital invested back inside, invested into other, private markets and sometimes public market. That's just the base of a family office, okay? So with that being said, this operational company is the one that's going out raising the money from these different institutions, credit investors that's going in, and they got a stake in this company. But this company here is actually buying up performing assets. They ain't dealing with too many ventures that's not making money. They're looking for to buy stuff that's already performing for commercial real estate, bulks of resident properties, maybe things. They might buy a company that own other subsidiaries, entities, because when you buy one company, you can own several under other companies or assets per se. You can't buy real estate that own company, but a company own real estate. That's the difference. An entity control land, right? People have it backwards. They think it's just land, but an entity or individual own the land, right? So with that being said, that is the side for dealing with an investment company, a fund, investment company, and a capital model. Because the capital model, where they raising the capital from private, it may be public sometimes, but most time they start off private, and they're dealing with a securities model. So they're looking for all performing assets. They're dealing with buying stocks, derivatives and things of that nature. So they're dealing with everything that's performing. No sitting around waiting for something to see how it's gonna work. They still sometimes lend or invest into ventures also and operate in the capacity of a venture capital. Now over here, like I said, you the general manager over here. It's a trust-only structure, and I guess up to you to figure out you want an irrevocable trust or revocable trust, and it's different categories come under both of them, but I just put a trust in general. We'll talk more about a trust in other episodes. So over here, you the founder or the co-founder, right? So over here, a venture. So now we talking about just a venture. Like I say about wealthification, it's a venture. It's not actually a fund. It's, Paper Circle Group is actually a capacity of a fund. It's an investment company, etc. So over here, you got a trust-only C corporation. It's a Swift Wake, same thing. It should be a Delaware Holdings. It could be a Wyoming, which is good at e-commerce and different things of that nature too. Technology company. So right here, you got Swift Tech, which is an operational company, and they got a valuation created, from the comparative of the market, or they got it from the multiple. They may have it under net asset value, different way they create a valuation. No performance to less performance. So we'll talk about something that just it's a projection. There's no money involved yet, no money being made, but it's all paper valuation. It got a great projection. It have things that it's going to do. It have things that it's going to attract. It's going to have a lot of users if we get this type of funding. Look at the story of Robinhood. I got a study case on how they started, and every time they raised the fund, the valuation was going up. So the first they attract over here, not saying angel investors invest, but a lot of time I don't see too many angel investors come into these type of, concepts. Not saying they don't, but over here, some of the first people that come in is your angel investor. What an angel investor is, most times your dentists, your doctors, well-off people. They may be 6 figures, 7 figures or better. They may not be all the way to term accredited investor, but they somewhere in that category. They can come and write checks for 6 figures up to 7 figures. And they group up with other angel investors. So, the funds start coming in, and they might want a preferred share. So I got preferred share optional. So you might want to offer them a preferred stock, what I'm saying? So they could be protected also. They might want both common stocks. So it's the same form as C Corp, 2 types of shares, right? And what comes about this with the angel investors is the angel investors bring in a minimum 100K to 1.5 million, and that's seed funding. Remind you, I always tell you, seed funding day is about 1.5. So that's the type of seed funding that a lot of these private held startup companies are raising behind the scenes, and we are still not in that stage yet. A few of us know and doing it, but a few that don't have a clue what's going on behind the scenes. So then after this seed funding is put in, implemented capitalization, what happens then? Then it goes into the next mode. Now we got payroll and legal and things that we could, keep things to seed. Might not be profitable. So what happens is you might attract what most people looking for. And this don't happen as much, but we just using the term venture capitalists. What's a venture capitalist? Someone that come in for high risk, high reward. They come in, they fund these companies through, equity finance. In most cases, they may lend it, but most time they come in, they buy a share of the company up. And when that happens is, it's a 3 to 7 year goal or objective. So they got objectives they looking for. Either they looking to push this company to the stream, right? Make it, go where they need to go at. So they got a plan for we gonna go public through via IPO. What is that? Initial public offer. So the company go public, they're gonna be in a cash out because they've been a private held owners for the last 4 or 5 years. So everybody looked at Facebook at 12, they went public. I said we should have found out how to do it when it was a private held company. So that's one agenda. The second agenda is selling the company off. They might be pushing it, see them and the founders on the same call. We're gonna put this kind of money behind you, 5 million, 10 million, whatever it may be. But we're looking for you to sell this company off, or might buy some more companies to strengthen this company position in the market to get more market share. Then the third goal, objective might be extremely profitable to increase the share, right? So that means if they brought this money, they just looking to increase their share of whatever they put into this company. So they invested 10 million, looking to walk away with at least 15, 20 million, or really way more. I'm just using a low ball, right? But they just want to share whatever the shares they bought that was private held. They decided to set it off. It might be a public trading company now. We could, double, triple our money, etc. So then after that, what happens is when it's more established, now you got more institutions. Not saying institutional investors ain't came in and invested into this concept, because they came into the beginning before venture capitalists might have came in, etc. While they was in. So, but what happens is private equity come in, and private equity like to buy companies that been around a little while. They got more of a stronger foundation, because sometimes it's new, they don't really trust it. They buy a new tech company, but most time it be more stable. You know what I'm saying? So this is just a funding structure. Break it down from you starting a fund or investment company or just a venture. You see what I'm saying? And they all work the same. It's all based on some type of corporate body entity, some type of C corp. It could have an S corp, but most times it's gonna be C corp. Like I always tell you, not a favorite guy on one side, just like to know both sides of whatever I'm doing, son. So I'm out. Shouts to everybody that's looking to raise funding through the equity financing side, or really don't got a clue how it works. Shouts out to you from thinking outside the box, because this is where the real equity money come in at when you start raising, do what you're supposed to do with investment capital, and you making good decisions and good move for you and your team in the future, and you prospering better because you got a team of people that's already in a position with you on payroll, etc. And this just the basic breakdown. Trust, and so trust only. So you own that, you control everything, like you keep hearing. That's the only way to move. If you ain't moving like that, good luck. I'm out. Later.